Hey, how's it going, guys? Welcome back to the Capital Mindset Show. Today, we're going to be doing another subscriber request, and this one is Crocs. You guys already know that from either the title or the thumbnail. So Crocs, for those of you who somehow don't know, is a shoe company. It makes those really comfortable, ugly little shoes that you put on your feet. Very comfortable. So I kind of surveyed a little bit, some of my family and friends, and, they all say it's comfortable. I personally don't own any Crocs. Maybe I'll go out and buy some Crocs because they're that comfortable, apparently. And, it's good for work from home environment, stuff like that. So I kind of just spoiled one of the potential tailwinds of this business that a lot of people are actually pretty bullish on, I guess. So let's actually go ahead and take a look at the price action, get a feel for what the heck is going on with this business. All right. So if we just look at this price action, we see that over the longer period of time, it's only gone up about 500% since IPO, which is, I believe, is a little bit of maybe not actually, but you would think it over a long period of time like this, definitely there have been businesses that have been better. All right. If you're a market timer, yeah, you did great because you bought it at the bottom, right? So taking a look at the 5 years, though, this is more recent. It's actually done really well, over 1,000% increase. So you've 10 extra money if you're an investor 5 years ago. And then they had this massive run up in 2020, again, because I think it has to do with the work from home tailwind. So a lot of people really don't like to wear these shoes out in public. But if you're working from home and your priority is comfort, then Crocs seems to be up your alley. Now, they have made some interesting acquisitions. We'll talk a little bit about that, but nothing crazy. They're not actually expanding into different types of markets. They're focusing on shoes, which I do like. I don't really like companies to diversify too much outside of their main business because sometimes that can be a deterrent. So it's interesting right here. I just read this. My eyes just went straight to this. Is school shoes for school day. I mean, like, sure, but I don't really see too many students walking around with Crocs. I do see a lot of people, at home, they have like slippers, basically. I think that's what Crocs kind of really caters to. They're like an Uggs of some sort. And I know that they're selling these Crocs with like fur in it and stuff like that. It looks very comfortable. But let's take a look more recently, though, how this actually dropped about 54% since the highs. And so some people might think it's really compelling. And I think that's why it was requested so often. So let's actually look at the 1 year and kind of see how it's done. It's about, only 4% in 1 year. So now it's underperforming the market over that 1 year period. And it's definitely come down with the liquidity crunch, kind of like how other stocks have. Because wait, let me see that exact date. Yeah. So this is actually a good example of the canaries we were talking about back in November. And a lot of exuberance on the way up. So, 126%. And then on the way down, about 54%. So you're basically back to where you were in March 2021. Now, I think we're going to go from here and actually go over the presentation. We'll kind of zip through this, kind of highlight only the important stuff or that I think it might be important. So let me zoom out here so we can kind of see the numbers here so I don't cover it. So 29% CAGR. Okay, so that's interesting because that's with the revenue growth. However, we want to make sure that's organic, not just only through acquisition, because they are acquiring businesses, again, in their same category. But I do think a lot of this is organic, right? And we do see interesting operating margins. Okay, so they are improving that. That's really good. I like to see that. Revenues are up. Oh, and by the way, I actually want to point this out. So revenue grew 29% compounded, right? And then what we want to see is the year-over-year growth in terms of operating margins, because I think this is the year-over-year growth. Sorry, that's the year-over-year growth in revenues. But we want to make sure that the operating margins are actually catching up to the revenue growth, and that means that they're maintaining their margins. Okay, so this is individualized each year, and so they had a massive 2021 growth. Okay, and again, I think that has to do with the tailwinds from work from home and the like. Okay, 2020 they had a decent growth of 12%, but that kind of matched the 13%. So they were growing okay. They were growing decently before the pandemic. It's just the pandemic really boosted their growth rates a lot. All right. So this is the breakdown of their revenues, and we can see that Americas is 51%. Well, that's, I think, the growth rate, not the market share. Okay, and then Europe, and you can see the like. I'll let you guys look over that. Exceptional fourth quarter results. Okay, so interesting increase there. And then this is the gross margin. So gross margins we want to see. Okay, so increase of 7%, 7.7%, and then 2019. This is I mean, the thing is, normally I'd really care about this but the thing is, in 2020 and 2019, the increase wasn't that drastic. So I think 2020 and 2019 is more comparable. It's 2021 that's the insane year. Some companies we've seen in the past, it's 2020 that's the insane year, and they're kind of normalizing. This one seems to be 2021 is this insane year. We want to make sure they don't normalize too much. So 2022 is going to be those numbers that I want to really take a look at, but we don't have those yet, right? So. Okay, non-GAAP operating margins. Okay, whatever. Diluted EPS. Okay, cool, I guess. All right, so this is actually where I want to focus on, because this is actually business targets, right? So they want to target, I guess, direct to consumer. That's when I see that word, I think that Asia is a growing market, buzzword there. Sandals, okay, cool. They're getting into sandals, and those don't look too bad. I mean, those are for kids, you know, but sandals are sandals. That's okay, I guess. You know, these are the shoes I really think of, right, when I think of Crocs. All right, so, oh, right there, digital sales. All right, yeah, so that's probably direct to consumer, and digital commerce growth 40. Okay, very good. I like that. Q4 digital sales represented 40. Oh, very good. I like that too. So it's actually making up a decent amount. By the way, I did not look at this beforehand because I like to have this raw with you guys. Okay, I always say that, but just in case for the newer viewers, this is how I kind of do things. All right, so Q4, okay, Q4 is pretty good. Q4 2020, Q4 2021. And remember, Q4, I think this is the what you might call it, the holiday season for them. So that's why I said it's pretty good, because we're taking a look at that. Yeah, we're just representing the digital sales. So I want to actually see who's the top one. So 39. Wait, this one came down. This one also came down. Okay, but globally, 40% is pretty good. Okay, so that makes sense because other parts of the world were a lot more strict in terms of their lockdown. So it makes sense digital sales actually were higher in those times. But we are higher from 2019. So that does suggest some consumer change in behavior. Okay, so 4x sales and revenue growth. Oh, and for those of you who don't know, Europe was very strict. So you see in 2020, it made up 60%. So really high compared to the Americas. All right, going down here, targeting 4x sales and revenue growth by 2026. Okay, so they want to quadruple the sales. All right, good to know. Fragmented for 30 billion. Okay, so that's your TAM. Let's go down here. Ugh, I don't know about you guys. That's ugly, but probably really comfortable. Okay, user generated content. Okay, so marketing innovation. Okay, so you're trying to connect with your audience. That's cool. Acquisition. Okay, here's the one. Hey, dude. Okay, they're doing the work for me. I was going to actually show you guys this, but Hey, dude is what they acquired. Shoes that look like this. I took a look at their website. Looks like it's targeted towards females, or at least that's what their advertising goes. That looks like a dude's ankles. So it's maybe they're, you know, it's diverse, but it is called Hey Dude. Okay, so critical position fills, financing. Okay, so this is actually some interesting parts. So they did a $2 billion term loan with B commitments issuing. Okay, so they issued shares for this. We'll actually take a look at their share growth. Expected to borrow $50 million of their existing senior revolving credit facility. Okay, cool. But they actually did repurchase, and then well, we'll take a look at that, but they're putting it on hold until they fix their balance sheet, and we'll actually take a look at that as well. New ambition, $6 billion in revenue. Okay, so that's basically repeating that. Where is it? 4x. Yeah, 4x right there. So that's what their goal is, right? And we'll take a look at their sales currently and see how far they want to grow. Building Hey Dude. Okay, so they want to build up this business. It's still in the shoe market, so I think it's not going to distract them. And then we'll look at the financials elsewhere. So let's take a look over here. This is their, let me actually zoom in. So this is their balance sheet right here. So let's take a look real quick at it. Cash and cash equivalents. Cash is actually rising. That's cool. Inventories. This is what a lot of businesses are having problems with, but it doesn't seem like Crocs is necessarily having the same levels of problems as other businesses. Goodwill. Okay, goodwill is there, but it's not crazy amount. Deferred tax assets, restricted cash, right of use assets. Okay, all this is, you know, nothing to highlight really. Down here, what I'm going to go straight down to, yep, right, long-term borrowings. So wow, that's a lot of debt they acquired. So that's about 771 million, by the way. It's not 771,000, 771 million, because if we take a look here, it's in thousands. So we add 3 zeros to that. It is a huge jump in debt. And yeah, so, but we'll take a look at the cash flows when we get there and kind of get an idea of, can they afford this? And let me see if it's right down here. So cash provided by operating activities. So based on their debt levels, and versus their CapEx, the free cash flow seems like it can heavily support that level of debt. So it shouldn't be a problem. The model will probably tell us that as well. What I'm not well, let's actually go back up to the income statement and see if we can get an idea of what the heck's going on in terms of their expenses. Remember, this is GAAP. So this is their cost of the products and selling general administrative expenses, no asset impairments, income from operations. So that's the income from operations. They had something that was added back, and that's actually what I want to take a look at, because this seems overly high, the net income. So because it's higher, their net income is higher than their income from operations. And so that interest income. Okay, so here it is right here. That was added in there. Interest expense. Okay, so then they subtracted that boy. And then let's see here. Income before tax. Okay, so then that was it. And then income tax benefit. Okay, so this is what caused it. So they have an income tax benefit of minus, and then that's basically added back. And I know that's kind of confusing, but when this is a parentheses and it's negative, this is normally a contra account. So then when it's a negative, it's actually a positive, and then we add it back. And if you kind of add that back, it's you get to that value. So their net income is higher, but I don't know how long this is going to be, because you see it started over here as a negative and then was really negative over here and then it's coming down a bit here. So I'd probably pay attention more to this or the cash flows. I'd pay attention actually the most to the cash flows, but we'll look at that. All right. Let me see if there's anything else to highlight over here. I think that's it. We'll go right to the model. Okay, so let's go over to the model and let's type in the ticker symbol, CROX, Crox. Let it load in. Okay, it's already loaded in, and then let's discount it at 10% to start out. So basically, if they don't grow at all at a 10% rate of return, that's basically what they're priced for, fair value of $98. But we'll get to that in a second. Let's actually explore some of this over here. So Altman Z-score of 6.7. So that's telling us no, it's not risk of bankruptcy, and then the model itself is telling us not risk of bankruptcy. Dilution accretion is not applicable here. Because they have actually declined shares. So don't even ignore that. It looks really high, but ignore it. And these again are still not functioning at the present moment fully. So ignore those. So max buybacks they are capable of is 10%, and then they've averaged out at 3.5%. So we'll actually price that in. I want to go take you guys down here to visualize the revenue. So the revenue has actually been a little bit cyclical over the longer term and estimated to actually go down according to analysts. Okay. So, and then the cash flow is about similar story. So cash flows are up right now and estimated to go down over here. Share count has been declining nicely. So they've actually been cannibalizing the business. So a small increase right there, but then basically down since then. They are returning cash to shareholders. Let's take a look at the return on invested capital. It's quite interesting that they are actually achieving a 54.7%, but I want to remind you guys that look at this rise. So that's why it's probably elevated. Normalizing in 2022 is actually the numbers I really want to take a look at. So a lot of these numbers are elevated at the present moment. Tangible book value is actually negative. Book value is actually positive here. And then we'll take a look at that. That probably has to do a lot with the debt and the liabilities that they're incurring relative to that. But remember, we take a look at the cash flows. It's not so much of a problem. And taking a look at the PE, it looks cheaper than it is, but on a cash flow basis, it's a little bit more expensive than that. So a little bit note on that. Analysts have it at a strong buy with a price target of 99.92, implying a 22.56% upside. Okay, and I'll take you guys over here because I know some of you guys like to look at this, and you guys can pause here, take a look at all this, and see if you guys like it or dislike it. I know they have actually a lot of females on their team. So, and then their dates and then their compensation public. All right. So key ratios, let's go ahead and look at this. So the liquidity ratios look quite nice, at least for the current ratio. Cash ratio has gotten worse since 2017, but not going to hold them against that. That's very conservative. Solvency ratios have gotten worse. Again, they've acquired a lot of debt. We saw that over there in the balance sheet. And yeah, debt to equity. Okay. cool stuff. Gross profit margins. This is actually really interesting that they've actually been improving this, and that's really nice. I mean, I want to see that this is maintained in 2022, but we saw it improving in 2020. I just want to make sure that they can maintain some semblance of it. The risk is that that actually does come down, and then the share price will actually, probably get hurt by that. And as I was saying before, just by looking at the numbers, remember, we want to derive stories from the numbers, not just look at numbers in stagnation and then just go, oh, so we take a look at this ROA, ROE. Remember, this is the DuPont analysis. The ROA, ROE, we can see that it got really high in 2020 and 2021. So then that is telling me, we want to see that normalize. I don't think it's going to stay at 5,000%. Okay. And remember, return on equity, that's also because the equity or stockholders' equity could be coming down a lot. And that's actually what is going on. So the return on equity, if we're using it off of a small number, of course, the return is going to look really high. So actually, ignore that. Okay. That's not, a little bit of nuance right there. It looks really good. A return on assets is probably a little bit better indicator here. And then return on invested capital as well. But remember, return on invested capital and return on assets, let's wait for the numbers to kind of normalize. I have a feeling that they will, because look at this, operating margins are crazy high now. Okay. Will they maintain themselves? They could, but I don't know if they're going to stay at 25%. Okay. I rounded, by the way, if you guys are wondering. All right. So, taking a look at the earnings quality is actually declining. And then that's actually something I don't really like to see. But earnings quality, it is declining, and we'll have to see longer term if it ticks back up. But usually we've seen that sometimes it's a correlation, not causation. So this is an example of one that did not have a suffering in share price when earnings quality declined. Okay. Because we can see, remember, let's go back to the 5 years. It's actually gone up. So, remember, it's correlation, not causality. All right. Okay. So let's remove that. And then again, this is still not fully working, but cash conversion cycle, pretty good. And then it has improved during the pandemic. So again, more signs telling us that the pandemic has been a benefit, right? Work from home and all that stuff. All right. So taking a look over here, let's actually we have some uncertainty. So if we discount it at 15%, require that margin of safety, we can't assume stagnation and growth. But remember, we did, let's assume, I think some 2% buyback, but they are going to stop it. So the buybacks might come later because they are going to focus on fixing that balance sheet because, the debt has risen quite substantially in comparison to the past. And, we've seen why they have acquired a new business, and then, they're expanding their core business. So I can't blame them for that. All right. So right off the bat, let's actually start assuming some growth rates. So the analysts have, depending on where you go, I think if you go to websites like Seeking Alpha, they have it at a growth, of like 30%. So in terms of sales, and then if we think they maintain some semblance of those cash margins, let's just say they grow at like 20% on the high end. And so you can see if they grow at 20%, this is extraordinarily cheap, right? But this is 20% every year for 10 years. So I really don't think that that's going to be the case. I think, for example, if we kind of normalize it, it's more like something around like a 10% on the higher end. And that would still be pretty good, by the way. And then let's go a little bit crazier. Let's say 15% and then 10% on the high end, and then 8%, 5%, and then a 2% on the low end. Okay, so if they grow at 2%, then we're not really there. We're almost there. So it is trading cheap. I'm not going to not say that it is cheap, but for something like this, I actually think that I would require a higher margin of safety because, me, I've said this in the past, I'm not really a fashionista. I don't really understand consumer trends regarding fashion. And, I've discussed this in the Foot Locker video that I didn't understand Foot Locker because I don't understand the shoe market. So why the heck would I not apply that same logic to something like Crocs? So for Crocs, I would need a very high discount rate. And even then, I really don't feel comfortable buying it. I would need it to be very cheap, just like how Foot Locker was kind of an experimental buy. And I haven't actually checked the stock price. Let me actually check the stock price live here. So FL stock. Oh, wow. I'm up a decent amount already. Okay. So, the portfolio is live, and I talked about it, and I made a video the day I bought it. So, to be transparent, it's not a crazy amount of my portfolio. It's kind of an experimental buy. The model was telling me it was stupidly cheap at the time. So we'll see how it turns out. But so far it's doing actually really well. I'm actually really happy about that. Maybe I'll take that money and go buy me some Crocs, right? Go buy a bunch of Crocs and then just fill my room with Crocs. All right. That would be hilarious. You know, just you look back here and there's just like a box of Crocs, and then your guys will be like, is Fabio okay? Has he gone outside in a long time? My beard's like full and stuff. Anyway, sorry about that. Just rambling. So yeah, Crocs is really cheap. I just don't understand it, guys. I really don't. I mean, you know what? I will go out and buy some Crocs. I will contribute to their revenue, and I will wear their Crocs, and then I will do market research. I'm going to follow people around, and just like, you know, my car, you know, get out and follow them. If they have Crocs, I'll follow them to the grocery store, watch them, you know, see what they do. You guys know the reference I'm making, by the way. If you don't, and comment down below, you have no idea the reference, and I'm sure someone will tell you the reference of what I'm making there. But you know, some crazy market research, guys. It's really awesome. All right, anyways, but that's pretty much how I feel about Crocs, right? That's my opinion. You guys may disagree, and feel free to disagree with me in the comments down below. Maybe I missed some things. Maybe I'm not addressing some risks. I think my risks, or what I see personally, and this is the summary of everything, I think the risks are margin compression coming back to normal, and the market's maybe not pricing that in. Maybe the market's a little too bullish on the growth going forward, and it's going to kind of normalize to historical levels. But here's the nuance to that, or the flip side of that. What the market may not be pricing in is that Crocs has turned the page and now is going to experience a ton of more growth. There's kind of a new trend going on that I don't understand, right? But that, just because I don't understand doesn't mean you don't understand it, but I don't understand it. And then maybe more and more people are going to wear Crocs, right? Maybe the work from home is going to, you know, stay, and then therefore people are going to be at home. You know, no, you can't see what I'm wearing below, so I can just be wearing some Crocs right now, and you know, who cares? I don't have to be wearing those really nice shoes, right? So those are some thoughts that I have, and I can kind of wrap my head around it a little bit. In order for me to be interested, I need it to be very cheap, just because I'm basically pricing in my ignorance, my stupidity, my lack of understanding. Okay. But I can understand why some people like it. I'm not going to say, oh, I have no idea that this is a terrible stock, whatever. No, I'm not going to say that, but I just couldn't, you know, myself invest in it at the present moment, just because I'm stupid, guys. With regarding shoes, I'm really stupid. So on that note, guys, I hope you guys enjoyed the video. If you did enjoy the video, go ahead and feel free to leave a like and comment down below again if I missed anything or anything like that. And if you're not subscribed, go ahead and subscribe, and then you might come back and see a stock that you've been looking at. And then over time, remember, I'm going to hopefully have a huge library of stock analysis, and, you know, covering all different kinds of stocks, eventually every stock in the stock market. And on that note, guys, I'll see you guys on the next one. Have a good one. Bye.